Hello, welcome back to Zodiac Trader. So today in this episode, we are going to talk about Fed again. So if you have seen my previous video, that I have made myself rather clear that I believe we're not going to have any interest rate hike in this year. And up to now, we're almost June, and we're still not yet seeing like any of the rate hikes. And because of the recent CPI data, that we can see that the inflation actually didn't. The inflation doesn't come down a lot. It just it came down just 0.1%, which is like really it's nothing. So that actually means that the inflation haven't gone down. So that's why the Fed decided probably they are not going to have any rate hike in the rest of this year. So my own point of view is that I believe the Fed will just maintain the high for longer uh, interest rate interest rate until that the inflation rate going back below 3%, or maybe like 2% for I believe for now. If you want that inflation data to going back down like below 2%, it will be extremely difficult. So I don't think that would be the case. I honestly believe that Jerome Powell and Joe Biden is going to come up some other plan, that they're probably going to say that 3% of um, inflation rate is tolerable, or maybe they're going to say they're going to use super core CPI. They're going to get rid of that shelter number, because that shelter number doesn't really go down, uh, and that really kind of it's making that CPI going up. So I believe that Biden is not uh, going to maintain that 2% of the target. They're going to play some trick on the inflation data. So I believe that's the case, to convince the voters that they have done something. Okay, they're going to likely they're going to convince the voter that they have successfully controlled the inflation back down, and hence why voters should continue to trust them, continue to put faith on Democrats. So they'll probably win the next U.S. election. I think that would be the case. So they're gonna figure out some other magic number to describe the inflation data. So let me right now move on, explaining why we're right now probably. I'm going to explain why Fed is pretty much stuck, and it increasingly difficult for Fed to control the market right now. And the reason why I believe we are heading to a U.S. banking crisis. To be more specific, that would be a liquidity crisis, and we're actually seeing a technical depression, despite of the fact that you are seeing a strong employment, that you think that the mainstream media have been saying that the economy is strong, but the opposite. I believe a lot of data that I've been seeing that doesn't look good. So I don't really believe that the economy is good. I don't believe the fundamental is strong, but because of the MMT system we're now in, the central bank can easily pump some money into the financial system. Hence why we're going to see stock market going up to historic high, and then typical pump and dump. So that's probably what we're going to see. So if you are a trader, if you're an investor, you will understand that the stock index doesn't reflect the economy fundamental. Like most of the time, stock index is just a index showing how much money in the financial system, and that's it. If you're seeing S&P reaching new high, that doesn't mean people going out on the street doing a lot of shopping. Okay, and the other data would tell you otherwise. So right now we're going to move on to this, and you hopefully be able to know precisely why the U.S. economy, is in fact in a depression rather than a booming. So okay, let's first talk about the. I'll just talk about the fundamentals. Okay, so there's several key data here that worries me because, for example, as you can see here, this is a delinquency rate on credit card loans or commercial banks. And we all know that 2020 Biden injected massive liquidity into the system. So especially for U.S. citizens, so U.S. citizens just take this free money, just go away and put in the stock market or whatever. Most of them have excessive amount of cash. I wouldn't say that poor labor. I would say from middle class uh, up and above the middle class, people just having this excessive cash, so they don't really need to use the credit card. So because they have all sorts of financial aid from the government, so cash wouldn't be an issue. So you can see that 2020, this number is at 2.66, and right now the number is 3.16. That actually means there are more delinquency number going on. Like after it is actually higher than 2020. Okay, so as we can see here, down in back in 2008, this number is at around around 5, I would say 4.77. And from now we are actually reaching we are kind of seeing these numbers going up to there. So I think it would be a great signal to look at, because people um, I mean, if the wage really goes up, what happened to this delinquency rate of credit card loans? I mean, the primary explanation of these delinquency rate rise is because the interest rate has been gone up to 5.5%, and we believe that if the most of our commercial banks are not actually priced in this higher for longer thing yet. So if they are keeping these high for longer, that actually means that it will be more expensive to pay off the credit card loans. It will be more expensive to pay off the debt and to make loans. And just it will be, for a household, it will be increasingly burdensome and will be extremely expensive for them to pay. So this is the first figure. And then let's look at the personal interest payments. So again, this number is skyrocketed because that you're seeing till 2024 March. This number is trading at 548.6. So this is a historic high. So people are actually, if you're paying more mortgage, you're actually paying for insurance that you're actually going to pay more. So we will move on to the insurance part later, because insurance will be crucial to understand the insurance fee and insurance costs. So right now, as we can see here, and personal saving. Okay, so 2020, as I have mentioned before, because the Biden administration put excessive amount of cash and inject in the system. So what we're seeing is an excessive amount of saving. And right now, this number has plummeted. It has gone up slowly, a little bit, but still, this amount of saving is still down, significantly. Okay, so what happened is during the 2008, the saving pattern is actually going up because people are reluctant to spend money. So this is something about rich people, right? If rich people don't want to spend money, they keep their money in the bank. It will be extremely difficult for them to spend money domestically because it's a global society. They're probably going to Bangkok or maybe going to Japan. They could probably spend money elsewhere, or they won't spend any money at all, right? Like if the stock crash, if they have like mortgage crisis, like poor people would tend to save money instead of spending the money. So it will be pretty bad, for economy to grow, because the United States is not a saving driven country. The United States is more of a consumption-driven economy system. So you need people to spend money, right? So you need people putting more money, spending more money instead of saving money. So if we look at the figure, the saving has gone down, and right now the saving has gone up because the interest rate is rising, and people actually feeling secure. And they're probably not willing to spend a lot of money, so their desires consumption has actually decreased based on the personal saving this chart. So there are many like charts that we look at. Like for example, this average hourly earning for all employees, total private. So we're seeing this wage has gone up, and I think this is very key components of the CPI. So that's why it's difficult to see that inflation going back down, right? So you have salary growth, you have on the other hand higher interest rate, and now let's move on to the car insurance and also the insurance cost of average household in America. So let's just say, like, because if you ever live in U.S., like, if you're from U.S., you understand what I'm saying. Like, you need a car in the state, right? You need to drive a car, but the car insurance cost has gone up like crazy, okay? Because the interest rate has been raised a lot, so that's why right now we're seeing the insurance company, in order to compensate that interest rate rise, they're actually raising the cost of car insurance. So now in 2024, the cheapest car insurance companies is selling their insurance at $1,547 per year. But the cost of car insurance is highly individualized, and premiums you pay are likely to differ from in our analysis. But as you can see here is the annual rates for car insurance. It has gone up. Okay, so in many states, if you're actually from, California, and you know that the average annual car insurance rate would like be crazy. Okay, so here are like car insurance for different states. Some people pay even like Delaware, the people pay for $2,000. In Florida, people actually pay for $2,500. So Louisiana pay for almost $3,000. So that's a huge amount of raising. That you see. This is happening because right now the insurance fee has gone up, and the insurance cost is actually not counted or not be summed in the CPI. So it will be really difficult to measure if people are getting rich or people just getting poorer, right? If people are getting richer, the cost should be down and their salary should be up. But right now, they are paying for a lot of insurance. If you're living in the States, it's very important to get insurance. It's very important for you to get a medical care, for you to get a car insurance, and etc. So that's why insurance is a big part. Okay, insurance consists of a very big part of daily cost. And right now, if we look at the life insurance statistics, like 90 million people, like nearly 1 billion families depend on life insurance. Okay, 41% of adults report not having sufficient life insurance coverage. Okay, so over half, 52% of Americans said they don't have life insurance because it's too expensive. Like American are aware that health history, age, or other factors affect life insurance quotes. And so you have all these numbers telling you how important it is for U.S. citizens to get a insurance. So right now, for this is a chart in 2024. So you're expected to pay, if you're a male and you're healthy, and you're like if you're 40 years old, you're like reaching the top income. Most likely, you have your best income in life. So if we take that from example, that you're approximately paying like 3,000 $520 like annually, and then you're actually securing for $250,000 policy. So that would be the case. If so, that would be the number. If you're 40, 50 years old, that number could go to $5,000. Okay, that is insane. And I would just say that it's just insane, right? So a lot of people are actually paying for more insurance, so that to be honest, they have to use more credit cards. Like some analysts, they're just saying that people don't really use credit card that much. But I'm saying most, I would say middle class, most of the middle class American, they have insurance. They have to pay for insurance. They will have car insurance. They have life insurance. So what if the interest rate gone up and stay there? It would just impact their insurance premiums. Okay, so here, this is another article. Okay, so it was published in the 2024 March 7th. So why have insurance premiums gone up so much? So higher insurance premiums for cars and homes are being driven by a mix of factors, including changing regulation, changing human behavior, blah blah blah. Okay, so here, this is an industry-wide phenomenon. For example, motor insurance was 25% more expensive on average in 2023 than previous year, and the average premium paid rose by 19% year on year. The average premium paid for private motor insurance in UK was £627 between and December and 2023. It's a 12% rise, guys. So figure 1 shows data between January 2021 and January 2024 comparing the retail price index, a measure of inflation, for all items with two specific insurance RPIs: the dwelling insurance and ground rent RPI, the vehicle tax and insurance RPI. The chart shows a clear jump in insurance RPI, which has risen by multiple factors more than all items in the RPI in recent years. So figure 1, RPI all items compare dwelling and vehicle insurance. So you see this red line goes up, and the dwelling insurance and ground rent also gone up, right? So how are like insurance premiums determined? Okay, so here, insurance companies are in the business of risk. To manage that risk, they must first calculate their expected future claims. So insurers use a multitude of factors to calculate expected claims. These include historical data on past claims, the size of pool of insured policies. Larger pools have more predictable claims, and trends that could affect future claims. For example, changes in weather patterns. So they also rely on analytical expertise and judgments of actuaries and underwriters. Actuaries assess and manage financial risk using mathematical and statistical models, while underwriters evaluate and price insurance policies based on risk analysis. The future expected claims are used to determine the pure premium, also known as the risk premium. This is the amount of premium required to cover claims only, without allowing for things like overheads and profits. So, the risk premium is combined with other costs to produce what's known as an office premium. The office premium is the actual price that the customer pay for their insurance coverage. So you're actually paying for the office premium. This reflects the total cost of providing the insurance, managing company, and ensuring profit. Okay, so there are 7 factors that go into insurance. So they are pure premium, expense loading, commission brokerage fees, cost of capitals, taxes, license, risk margin for profits, contingencies, reinsurance costs. So basically what happened is cost of capital gone up and risk of managing profits, contingencies gone up. So there are approximately 2 to 3 factors that's leading the higher insurance premium. Okay, so what we're seeing now is a breakdown of premium cost here, and I mean, like, you can see this chart. This is like horrible. Like you see that people are actually paying for more insurance um, than they should, right? Because the interest rate has gone up, right? And it will be extremely difficult if you don't buy any insurance. You will have a very difficult life. I mean, anything, should anything bad happen to you, or maybe some unexpectancy happens, you end up paying loads of money in the hospital. So that's crazy. What's crazy right now? That's why people are actually like more poor like than you think. And this topic has also gone up to New York Times. So you see another article saying, why is car insurance so expensive? Because the premiums are soaring. Okay, so that actually so actually Biden administration think that if they control the petrol price, they put down the petrol price, they make those commodity cheaper. They think the inflation is going to back down. But right now, yes, you probably have end up having a cheaper WTI petrol oil. But now, because the interest rate has gone higher, and you have a soaring premium on the car insurance, so that's what's happening right now. Because uh, the Biden administration and also the central bank, the Fed, is ignoring um, these data. Okay, what they're doing is, like they are so data driven. That actually means they only look at the data. Okay, if you're being said like as data driven, you're not ahead of curve. You are following the curve. You're following the market. So from this perspective, I don't think you're actually managing the market. You are actually being managed by the market. Because you allow the market to manipulate you, because every time when the mainstream media and also Wall Street people, when they look at the inflation number, doesn't matter if the CPI has gone up or just gone up but just a little bit. Even if it just gone down for a little bit, they would say, okay, this is a sign of lower interest rate. I mean, that's just insane. Like, how the hell would you be able to understand that the Fed is going to lower the interest rate only because the CPI has only dropped like 0.1%? So this is ridiculous, guys. It's just ridiculous. So in this video, I've shared about all these reasons why we are seeing a depression right now. Because you're seeing more saving, you're actually seeing people spend less money, people are having more delinquencies on their credit card, and people are actually paying a lot more on their insurance, which means people, and not to mention the house, the price of the house, the price of the tuition fee. Like next time, I will make a video about how this tuition fee and house price has gone up, and people just simply cannot afford. So what they do, what a politician do, they just make up some CPI number or maybe a supercore number, and they just exclude all these very important numbers, excluding these insurance costs, excluding these tuition fee, and etc. Okay, and then they just come up with this number and saying, hey, the inflation is not high, so we are free to print more money, because inflation wouldn't stop us to print more money, and therefore you're going to see stronger stock market. If you look at the stronger market, that okay, well, let you know that okay, you have a strong stock market, so must be a good economy. So this is what people are behaving right now. I mean, it's a huge bubble right now. So we're going to see. I'm not saying we are going to short the market right now, but we're definitely going to see a really big bubble forming. Okay, thank you guys for watching. If you like my content, please subscribe. If you want to comment, please comment in the comment section to interact with me. So I will see you in the next episode. Goodbye.